What if the biggest threat to Bitcoin's price isn't traders, not governments, not even whales, but the very companies that mine Bitcoin itself? Right now, some of the largest Bitcoin mining firms in the world are quietly selling BTC, taking on massive debt, and pivoting their operations toward artificial intelligence. This isn't speculation. It's happening in plain sight. And if you're holding Bitcoin, or thinking about buying, it raises a serious question. Are Bitcoin miners about to become the next major source of sell pressure? Or is this entire narrative just fear, uncertainty, and doubt designed to shake weak hands? Today we're breaking down what's really happening inside the Bitcoin mining industry, and more importantly, what it means for Bitcoin's future. Whenever Bitcoin struggles or pulls back, most people immediately look for obvious explanations. They blame traders, macroeconomic conditions, interest rates, or institutions taking profits. But almost no one talks about Bitcoin miners, even though they're some of the largest BTC holders on the planet. Miners sit at the very foundation of Bitcoin's network. They secure the blockchain, validate transactions, and earn Bitcoin directly from the protocol itself. In other words, miners aren't just participants in the Bitcoin ecosystem, they are the infrastructure. Yet recently, many mining companies have started selling Bitcoin, tightening budgets, and even shifting their core business toward AI and high-performance computing. So today we're separating facts from fear by diving deep into who the biggest Bitcoin miners really are, why some are selling BTC right now, why others are pivoting into AI, and whether any of this actually threatens Bitcoin itself. When people think of companies holding massive amounts of Bitcoin, they usually picture corporate treasuries or large institutional investors. But in reality, Bitcoin miners often hold even more BTC, and unlike treasuries, they don't buy it on the open market. They earn it directly, block by block, as a reward for securing the network. Some of the largest mining companies today collectively control tens of thousands of Bitcoin, placing them among the most influential long-term holders in the entire ecosystem. For years, their strategy was straightforward and highly effective. Mine Bitcoin, hold it through market cycles, and let long-term price appreciation do the heavy lifting. During bull markets, this approach looked brilliant. Rising BTC prices boosted balance sheets, strengthened investor confidence, and allowed miners to expand operations using their Bitcoin holdings as collateral. But recently, cracks have started to appear. Over the past year, several major mining firms have sold hundreds, or in some cases, thousands, of Bitcoin. Others haven't sold yet, but financial pressure is clearly mounting as operational costs rise and profit margins shrink. Now, it's important to put these sales into context. So far, the total amount of BTC sold by miners represents only a small fraction of Bitcoin's overall supply. And in most cases, these sales didn't hit public exchanges directly. They were executed quietly through over-the-counter deals, limiting immediate market impact. That's why Bitcoin's price hasn't collapsed despite these sales. However, the real issue isn't what miners have sold so far. It's what happens if these sales accelerate. If more miners are forced to sell consistently, month after month, it could change the market dynamic, especially during periods of weak demand. And that's why this trend deserves attention. Because to understand whether miner selling is a short-term adjustment or a long-term risk, we first need to understand the economic pressures miners are facing. And that brings us directly to mining economics. The single biggest shock to Bitcoin miners came from the most recent Bitcoin halving. When the halving occurred, block rewards were cut in half overnight. That meant miners instantly began earning 50% less Bitcoin for exactly the same computational effort. And while revenue dropped immediately, costs didn't fall to match it. In fact, for many miners, costs moved in the opposite direction. Since the halving, several critical trends have unfolded at the same time. First, global hash rate has continued to climb. Instead of miners shutting down en masse, new machines were brought online, older ones were upgraded, and competition intensified. Second, mining difficulty adjusted upward, as the Bitcoin network automatically does. This made it even harder and more expensive to mine each new block. And third, competition between miners has become far more aggressive. Only the most efficient operations can survive, while smaller or less optimized miners are slowly being pushed out. Put all of this together and the economics become brutal. Current estimates suggest that the average cost to mine a single Bitcoin now sits between $100,000 and $110,000, depending on energy prices, hardware efficiency, and geographic location. Meanwhile, Bitcoin's price has spent extended periods trading below those levels. That creates a situation where many miners are operating at razor-thin margins, or in some cases, mining at a loss with the hope that prices recover in the future. But mining at a loss isn't sustainable forever. When margins disappear, miners are forced to make difficult decisions. Sell Bitcoin to cover operating expenses, delay expansion plans, shut down inefficient machines, or restructure their entire business model. This is where pressure really starts to build. Because Bitcoin miners can't control the price of BTC. They can only control their costs, and those costs are being squeezed from every direction. As a result, survival increasingly comes down to two options: cut costs aggressively through efficiency, scale, and cheap energy, or find entirely new revenue streams that can subsidize mining operations. And it's this second option that has pushed many miners toward artificial intelligence. Over the past year, nearly every major Bitcoin mining company has announced plans to expand into AI or high-performance computing. The reason is simple: AI pays more. For every unit of electricity consumed, AI workloads can generate 2 to 5 times more revenue than Bitcoin mining. And here's the key advantage miners already have: access to large amounts of cheap power, industrial-scale cooling infrastructure, data center expertise, fully automated, always-on operations. In many ways, Bitcoin miners are already running the type of infrastructure AI companies desperately need. This has led some mining firms to rethink their long-term strategy. Instead of viewing Bitcoin mining as the end goal, they now see it as one use case among many for monetizing energy. In extreme cases, a few companies have even announced plans to significantly scale back, or eventually exit, Bitcoin mining altogether. That sounds alarming at first glance, but it's still not the full picture. Despite the headlines, Bitcoin mining itself is not going away. Here's the key point many people overlook: Bitcoin is self-adjusting. If miners shut down, the network responds automatically. Mining difficulty drops. Mining becomes cheaper. New miners enter. We've seen this exact process play out before. When China banned Bitcoin mining in 2021, hash rate collapsed almost overnight. Difficulty adjusted, miners relocated, and the network continued operating without missing a beat. Bitcoin doesn't rely on specific companies or jurisdictions. It relies on incentives. And those incentives always rebalance. Ironically, miners generating additional revenue from AI could end up strengthening Bitcoin by reinvesting profits into more efficient mining operations. So, should Bitcoin holders be concerned? In the short term, yes. Miner sales can increase volatility, especially during weak market conditions. Debt pressures may force some companies to sell BTC or dilute shareholders. But none of this undermines Bitcoin's core fundamentals. The network remains secure. Institutional demand continues to grow. And long-term supply dynamics remain unchanged. Bitcoin has survived far worse challenges than this, and every time, it has emerged stronger. The real question isn't whether Bitcoin will survive. It's whether you'll have the conviction to hold through the noise.